Viewers, thank you so much for visiting this video. My name is Isaac Jonas and I like to talk about personal finance and investing. And today I'm going to give an economic update of what really transpired in the US, particularly the major market updates and also the major economic news that I believe drove the market's volatilities this week, and also how I'm investing and trading. But the first thing that I will say is that the US stock exchanges, as measured by the S&P 500 and other major indices like the Nasdaq and the Dow Jones, they were down. And because you can see that this week the S&P 500 was minus 1.69% down, and the Nasdaq was minus 0.68%, and also the Dow Jones was minus 2.4%. So what this means is that there was a sell-off. What happens when I am investing, and what I have seen is that there are usually two things that happen. There are sellers and buyers, and when sellers are really in control and they are aggressively selling off, right, and pushing the price down, that's when the price retraces. But there has been various news that has been unfavorable. For example, the geopolitical tensions in Israel and Iran, also in the Middle East broadly. So I believe most investors have been selling off because people don't know what's really going to happen, right? And also I've seen that the DXY, which is an index that is a benchmark for the US dollar versus other currencies, has been increasing as the major market indices like the SPX, the Standard & Poor, have been declining, and also gold has been going up. So my explanation to that is that possibly investors, they are actually going for a safe haven. They are buying gold, they are also hedging and buying the US dollar futures like the DXY, right? And what this means is that they want to protect their capital. So the way that I look at it, for me, is that there's going to be the Federal Open Market Committee. In other words, the Federal Reserve Bank, they will be meeting towards the end of April to the 1st of May. And when they meet, they are going to decide if they are going to increase the interest rates or to leave them unchanged. So in other words, the monetary policy. So what has been possibly causing the markets to react this way is that some governors have been indicating that it's very possible that interest rates may not be reduced this year, right, by the Federal Reserve Bank. But also there might be a possibility of even increasing the interest rates. Why? Because inflation as measured by the CPI has been increasing, right? And the major mandate of the Federal Reserve Bank is to keep inflation target at 2%, right? And bring price stability. So one way of fighting inflation is to increase interest rates. In other words, if, for example, a car is overspeeding, right, the US economy in general, I'm just giving this as an example, you press the brakes, but you have to do so slowly, otherwise it can overtake. So in other words, if they increase the interest rates, possibly it may increase the cost of borrowing, but the US economy might possibly go in a recession, in slow down, right? But the challenge is that the economic numbers, they've been very strong. For example, the initial job claims on Thursday, they came out lower than expected, 211,000 versus 216,000 expected. In other words, less people filed for unemployment, so more people are at work. The producer price index, it also, for the month of March, it also came lower than expected, 0.2% versus 0.3% forecasted by analysts. The purchasing producer price index, essentially it measures the change in price of goods sold by manufacturers. In other words, it didn't increase that much. But there is conflicting data here. So I'm going to just say what I think. I'm not going to say I know what's going to happen in the future, because there are a lot of unknown variables. So what I do is I simply take advantage of these volatilities, right? When I'm investing, it's like a marathon. I simply invest in mostly about 40-50% of my portfolio, for the family portfolio, is invested in the index funds. That is, that straight the S&P 500, because historically it has retained about 10% per year. which is very good. I also have some of the money that is in Berkshire Hathaway, which is managed by Warren Buffett. Why? Because it's not just one individual stock. There is Apple. Last time I checked it at about 50.03 or 04% in Apple. There's also Bank of America and Occidental and other companies, right, that are in Warren Buffett's managed portfolio. But also, they also keep quite a lot of cash, over 120 billion. The last time that they filed, they did their annual letter to the shareholders. So what this means is that if the market drops, a lot of companies will be undervalued, and that's when Warren Buffett and the leadership, they get in and start to buy companies when they are really discounted. So investing, in my view, is very simple, in the sense that as long as you control your emotions, the psychology of investing, you understand where you're investing your money, and you are patient and you wait for the right opportunity. So I simply dollar cost average. Today, when the S&P 500 was dropping, I added some money in the index funds that track the S&P 500, for example, SPY. It's not investment advice, but I'm just sharing in the interest of transparency. So I'm just dollar costing averaging, right? And only when I understand the individual companies, right, and I only invest in very few when they are really beaten down, like when there are major events, like the market is selling off, there's something that has really happened, and I only invest in companies that I understand, 4 or 5, and I've done videos to explain how I do my research. I don't like to invest in too many companies and in too many individual companies, because I might be wrong. So if the exchange traded funds that I hold, 2 or even in Berkshire Hathaway, they give me a decent return, and I have 1 or 3 or 4 individual companies that are really down when I get in, and they have very strong fundamentals, and I put not more than 10%, that might, from what I've seen, my return, that gives me a very decent return, but also it lowers my risk. But I also like to keep some cash. I have about 30 or 40% of the portfolio in cash, and I keep on just averaging down. But also, when I'm trading, that's a different story. Trading, I don't really care what direction the market is going. I trade options. So if the market, like I trade SPY, for example, if the market is going up, I'm taking calls. If it drops, I'm taking puts, in other words. But I get in 2-3 minutes. But trading options is very risky. You have to educate yourself. It's very important that you understand that investing and even trading is very risky. So I really don't risk the money that I'm not willing to lose. But for me, my long-term portfolio, I only invest in companies that I understand, very few of them, and only in exchange traded funds, like I've said, right? And that's it. It's very simple, and I keep some cash. That's my simple strategy. And I also hedge my portfolio, like I said, in volatility, in exchange traded funds like the VIX. And at some point, if the gold exchange traded funds, drops, right now it has gone up because I believe some investors, they are going to gold as a safe haven. I will consider just, buying it when it's down. And some people, they do bonds. So that's what I do in short. So in conclusion, I just want to thank you so much for staying this far. So please make sure that when you invest, please understand. If you don't understand, consult financial advisors. So thank you, and if you haven't subscribed on this channel, please consider doing so. May the markets be with you. Have a wonderful week. Thank you so much again.